Well, I do believe that the stock market, has been discounting this for a good part of this year. The market is in a bear market. So the equity market's not going to be surprised, and even the fixed income market's not going to be surprised. The yield curve, so the difference between the 2-year and the 10-year Treasury yield, is over 80 basis points, 0.8%. This has not happened since the 80s, the early 80s, when Chairman Volcker, was taking a sledgehammer to inflation, an inflation problem that had built up over 15 years. This inflation problem built up over 15 months. And instead of increasing interest rates twofold, 10 to 20%, which is what Volcker did, Chairman Powell has taken interest rates up 16-fold. Again, never seen that before. And I do believe that the surprises now are going to be on the low side of inflation expectations, dramatically so. We believe that inflation will drop below the Fed's 2% inflation rate sometime next year. And the pipeline is telling us that. Commodity prices, inventories, which are overwhelming and causing all kinds of discounts. And the bond market itself, whenever there's a yield curve inverted, it is saying, okay, growth is going to disappoint, or inflation is going to be lower than expected, or both.
And so does that mean then, Cathie, that we're not going to see, say, a terminal rate of 5% or above from the Fed?
I would be very surprised if we see anything like that. I think one of the most visible commodity prices out there, oil, despite a lot of potential support, can't get going. It peaked at $130 per barrel after Russia invaded Ukraine. It's now down to $74. And even with China opening up, we think, supposedly a support for oil prices, it can't rally. So I see you're putting up here 71.60, but that would be yet another proof point. So.
Yeah, and so are all the sales, I guess, that we're seeing when we go Christmas shopping, a lot of folks on a lot of items, Cathie, as we see that start to feed through. So again, if this scenario is correct, if we are going to see inflation start to come down more sharply than anticipated, if we do see the Fed then slow down interest rates or even stop raising interest rates earlier than anticipated, bring it back to your portfolio and what that means for where you're investing.
Well, if you look at what has outperformed in the last year or so, we've seen the beneficiaries of inflation outperform. Now, I just told you that oil prices have come down from $130 to the low $70 range, almost cut in half. And yet the XLE, the S&P energy sector index, is not that far from all-time highs. So there's a bit of a disconnect there. And there we go. So what you will see as inflation unravels, interest rates come down, raising the present value of future cash flows, that kind of environment benefits our portfolio. We have stocks in our portfolio, companies that are going to be extremely profitable in the next 5 years. Right now, they may not be that profitable because they're investing aggressively to capitalize on some amazing opportunities in the genomic space, robotics, energy storage, artificial intelligence, blockchain technology. They're investing now because many of these are going to be winner take most markets. So they're huge markets. And therefore, there's latent profitability. The gross margins in our portfolio, so just taking a cost of goods sold from revenues, the gross margins are very high. And what they're spending on R&D, sales and marketing, stock-based compensation to attract talent in these early days is really important to their future success. So as interest rates come down, the present value of future cash flows going out 5 years, the present value of those increases.
So, Cathie, if I might, so you think interest rates are actually going to come down because the scenario that you were describing before, right, with the incredible increase that we've seen in rates already, even if the Fed doesn't get to 5%, even if it gets to 4.5%, right, and stays there, isn't that going to continue to be a headwind for some of these growth companies, some of which rely on lending, for example, on debt to do some of the investing you're talking about?
I think a change in rhetoric toward, hey, maybe we're not going up after 4.5%, or a change in rhetoric will get the market going. The market is trying to figure out how high is high, and you've got some observers, economists out there thinking it could be 6 or 7%. And so the market is holding back and saying, wait, we need some evidence. Now, I think the evidence is becoming very strong because long bond yields are down at 3.5%. The long bond market does not think interest rates are going to 5 or 6%. It's been moving in the opposite direction. We got up to 4.25% on the 10-year Treasury, and now we're down to 3.5%. So the bond market, I think, is speaking pretty loudly, and the bond market itself, which would be the most sensitive to rates going up, is moving in the other direction.
Cathie, we have to get to your performance because you could say the equity market is speaking as well when it comes to the performance that we've seen of your benchmark fund this year. ARK down more than 60%. And I know we've talked about this before, that you are a longer term investor. But if you look back 3 years, you've underperformed the S&P 500. If you look back 5 years, you've underperformed the S&P 500. In fact, if you go all the way back to 2014 when you started the ARK fund, it still underperformed the market. So what catalysts can investors look for to turn that around? Is it going to be the interest rate scenario that you're describing?
Yes, we have never seen a market like this. This is worse than 08, 09. And I think many technicians basically took a chart of the tech and telecom bubble and the bust, and they said, okay, that's what's going to happen. That has happened to us and more. This is worse than the tech and telecom bust. The difference between the two periods is we've got into an irrational market in the late 90s. Investors were piling on technology stocks, actually trying to outcompete indexes and each other. So they ended up with 40% technology, but the technologies were not ready. We didn't get cloud until 06. We didn't get breakthroughs in deep learning until 2012. Not only were the technologies not ready, the costs were way too high. To sequence the first whole human genome, it took $2.7 billion for one person's genome in 2003. Today, that's 500. The technologies are ready. The costs are low enough. The seeds for what we're investing now were planted during the 20 years that ended in the tech and telecom bubble. That was irrational. And I think we're on the flip side of the bubble right now. I think what's going on right now is irrational. Many of our stocks are below where they were at the low point in 2020 when COVID hit. Some of them are back to 2017 levels. And a company like Teladoc, its revenues are up 14-fold since. Its gross margins are in the high 60s, we think moving into the 70s. And that compares to the NASDAQ's 43% gross margins. See what I mean about latent profitability? They have a lot more to spend to make this backbone of the healthcare.
Well, Teladoc also still loses money, right?
This is what I'm getting back to. High gross margins, high 60s, low 70s. This company, its ultimate profitability is going to be superior because we believe it will become the healthcare information backbone of the United States, if not elsewhere. So just think about that. High 60s, low 70s gross margins compared to the NASDAQ, 43%. And yet the stock is selling for, I believe it's around 2 times revenues, whereas the NASDAQ is selling at 3.25. This is as irrational on the downside as the upside was in the late 90s.